when you turn on revenue is sort of superfluous. In fact, you might accidentally crush the company by turning revenue on too soon, because now I have to support paying customers with all this operational process of support and customer service and blah, blah, blah. And then that becomes a capital drain on my limited dollars that I need to continue to still build out the platform and my marketplace and blah, 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 blah. So, it's like, well, the hobbyist amateur VCs hate my guts.
Because you just got me thinking differently. We are back with another episode of the Cold Star Project. This time we're going to look into blockchain and funding and VC stuff. It's really cool. I've got Michael Hiles here, who runs a tech business and is very interested and into the blockchain field. You've actually come up with your own fund. And I thought we'd talk a little bit about that today. Could you tell us a little bit about what you've done? What have you accomplished on the blockchain fund side?
Well, that's a big question. So we do have the software company, which is completely separate. It's an enterprise software fintech platform for traditional capital and finance. So we're innovating that space, disrupting that particular space. And that's not the typical Bitcoin, cryptocurrency stuff. This is bringing efficiencies to an inefficient capital market that already exists, municipal bonds, for example. And then we have the separate fund, which is an investment vehicle that we have been working diligently for a while and have specific strategies for investment return in the fund that represents a couple of different things, like buying and selling cryptocurrencies against a particular formula for arbitraging the marketplace, and then looking for additional infrastructure-based companies like mine. Blockchain and just technology in general represents a lot of opportunity for disruption, and we're interested in eyeballing those things as well. And really, another component to the fund is the federal government made some changes that made it very beneficial for investors to put money into what's called an opportunity zone. And that's a designated area geographically that brings some very significant tax benefits to investing in both real estate and then at-risk venture capital type investments in businesses that are located in those opportunity zones.
Okay.
So we're just do all kinds of fun stuff.
And yeah, that is a big range of things. Now, I should say for our listeners, I've known you for years, and you're always on like the super serious, from my perspective, deep level, actually getting things done with real companies, as opposed to much of the stuff that I see on Facebook, for example. You're not on Facebook very often. And when you do, you're like, we met with the president of the University of Florida, and now we're doing some crazy, awesome thing, right? So I think that is the kind of story that I'd like to share with you today. Tell us a little bit about the business. I mean, you're wearing the T-shirt. Listeners can't hear that, and it's kind of cut off there, 10XTS. Tell us a little bit about that.
So 10XTS is a fintech software company. I've been coding for my entire career, has been associated in some way, shape, or form with selling technology, developing technology, and in particular software and software development. So 10XTS is just the next thing in my career. We saw the opportunity that was coming, not around necessarily Bitcoin and Ethereum and the cryptocurrency space, but then the ability to apply that underlying technology to solve real-world existing financial services problems. Well, not just financial services, but problems in general around marketplaces and making capital more efficient, basically.
Okay.
There's many swaths of the financial market that is incredibly inefficient and costs investors billions of dollars annually in just stupid bullshit like administrative fees. Like the time to settle a transaction, for example. It's an incredibly inefficient process. A lot of it has to do with the bureaucracy around regulatory and licensing and reporting and those kinds of things. But when you look at the problems that exist, in particular with the kinds of technology we have at our disposal now, there's no reason why we can't fix some of these things and save everyone billions and billions and billions of lost capital annually. So
awesome. So clearly, Michael, you're working at a different level than what most of the online marketers are working at. And I wouldn't even put you in a similar category. So, a couple of years ago, Bitcoin was hot. It was the bandwagon thing. There were all those events, remember, where people were going, for a few months. It looked like it was going to go on forever. I never bought into that at all. And I've been very wary, actually, about cryptocurrency while following it. And then I see you get into it and go, well, I've created a real fund here. And for
and in fact, our real fund last year did 86% rate of return in the middle of the crypto winter, and we'll probably do 150% this year if the models pan. And this is like real dollars. We don't stay in cryptocurrency. We come back to cash, right? This is an entire trading strategy where it's pretty sophisticated. The guys that are behind it. I'm not a quant trader. I wish I were that brilliant. But the guys that are behind it they're literally physicists that figured out they could make more money in the financial market than teaching physics at a university somewhere with their PhDs. So they write these incredibly complex strings of mathematics that tell them how to interpret and read the market, the behavior to take based on the market. And they're really, really good at it. And it involves basically the idea that, Bitcoin, whether you believe in it or not, people are buying it and selling it, and they're buying it and selling it at, billions of dollars rate on many exchanges globally, which means there's no single price for Bitcoin, right? There's no one centralized price authority for Bitcoin. The price for Bitcoin is based on whatever exchange the Bitcoin is traded on. Well, there's variances. If Bitcoin at the same time could be one price on one exchange and, is a different price on a different exchange. And if you know what the momentums are for each of those exchanges, you know which exchange to buy on and which exchange to sell on, sometimes almost automatically. And just playing the arbitrage between the price discrepancies of the exchanges. That's what quant traders do on Wall Street, right? So it's applying that high frequency trading strategy, that quant strategy to crypto assets, digital assets.
Okay. Now you're a big player in the Cincinnati Founders Institute, which is like
I run. Yeah, I was the founder and run the Cincinnati chapter of Founder Institute. It's part of Startup Cincy. Represent. So we're one of the accelerator programs. Founder Institute is the world's largest pre-seed accelerator program. Okay. So we're like before you go into Techstars, before you go into a Generator or Plug and Play, some of the bigger accelerator programs. Those are all later stage. That's when your company's far more developed. Founder Institute's headquartered in San Francisco. Was founded by Adeo Ressi in 2009. Adeo was Elon's roommate at University of Pennsylvania, UPenn. And Adeo went on to create a couple billion in shareholder value himself. So he's a pretty smart guy, capable guy. And so I founded and launched, we pulled a team together and created a community around Founder Institute Cincinnati, because we needed that early stage in the Cincinnati community. All of the VCs and accelerator programs are all, once again, focused on later stage stuff, and there was nothing for the first timer, the first time around CEO that has never done it before, right? I've never started a company. I have no idea what venture capital is and how it works. I have no idea how to, value my company. I don't know what a convertible note is, or liquidation preference, or all of these things, and you have to know these things as a founder. It's cool to start a business that you can just go out and hustle and sell, and that's ultimately what it's all about, right? But you're gonna hit the ceiling, and I think that's where a lot of solopreneurs, because they don't have that next stage business understanding. They didn't go to B school, or they don't have that. They don't know how to structure their business in such a way that they can scale beyond the, even $1 million a year. I know solopreneurs that are out there knocking it down, right? But they're just good salespeople. They found a niche, they found a market, and they're good at selling into it. And okay, it's cool. It's a lifestyle business. One problem though is with lifestyle businesses, you stop selling, you stop getting paid.
Yeah.
So if you want to build an asset that's going to outlive your life expectancy as the founder, the entrepreneur, then you need to understand how to put infrastructure in place, capital, scale, processes. Blah, blah, blah.
Something I know a little bit about.
Imagine that. Process.
That is the point of this podcast, to talk about the unexpected challenges of scaling. So we're right in there. So I hope by this point in our talk, our listener has got the picture here that you know what the heck you're talking about when it comes to that second level of entrepreneurship. I've seen you say it's great to hustle and kind of echoing what you just said, create revenue dollars, but what about balance sheet dollars, right? That's really where
the majority of the global wealth is balance sheet dollars, right? Warren Buffett doesn't have $60 billion in $20 bills sitting in his vault in Omaha, right? It's balance sheet asset wealth. And make no mistake, that's legitimate. A bank will look at your balance sheet and say, well, I've got, 56% ownership in this company that's worth, $6 million. Well, why is it worth $6 million? Well, I was able to raise capital by selling shares in my company to someone at a price that values that asset at $6 million. It's like, people are like, oh my gosh, isn't that funny? Funny money? No, it's not funny money. If I sell 10% of my company to somebody for $600,000, that means the whole company is worth, $6 million. And if I own the majority of that, my balance sheet, my net worth says, I've got X million dollars, right? Now, I don't have that in the bank. I can't spend that. And in fact, where the funny money comes in is this concept called liquidity, right? Can I get money for that asset, right? And that's where people get hung up on it. Like, balance sheet wealth is great. And that's why balance sheet wealth is great when you own publicly traded companies, because the shares that you own may as well be dollars in your wallet, because I can go out and sell shares on the public stock exchange, get cash
money for them.
Right. Unfortunately for me, if I want to go sell shares and say 10XTS, want to sell my shares, if I could even find a buyer for it, this is very illiquid. It's a high risk, private company. And if I were able to find a buyer for it, I'd probably have to discount the price so much in order to induce them to purchase that asset. It's probably not going to be worth it my while. So
back to building value. Okay. So with all this background that you've got, you saw that there was an opportunity to create a certified fund. Now you get all these guys who will spam you and say, hey, I've got this fund, do you want to invest? And they're not even legally allowed to be doing that.
That's right.
And I see
in fact, you can drop a dime on guys. Oh yeah, I'm Mr. Regulatory Compliance. Always made me a Bitcoin pariah in the early days when all the ANCAPs were beating the drum. And then now everybody is, oh, we're regulatory compliant. I'm like, well, what does that even mean, right? And it's like regulatory compliant. Stating to the world that you're regulatory compliant is like your local restaurant stating to the world that they passed their health inspection. Right? It should just be the way that it is, right? It's like
an expected minimum.
Right. It's like, oh, now you got all these crypto companies that are out there like, oh, no, we're regulatory compliant too. Like, anyway.
So what made you say, all right, I'm going to go create a fund here? What made you take that jump?
It was the result of a conversation with an older gentleman, attorney, mentor, investor. We were having a conversation a couple of years ago around, how do we put together a fund that allows high net worth individuals who are never going to learn the technology necessarily, but allows them to participate in, call it weekend at Vegas increments.
Mm.
Very, so the average person, it's a lot of money. It's, a really nice car, right? But, to high net worth, it's like, I blow this much in Vegas on the weekend.
Mm-hmm.
And it gives them something to talk about at the cocktail party. And then wouldn't it be cool if we could just experiment and play with it? And so that was literally the genesis of the fund. And part of that was because my partner is a tax attorney. And so he has done thousands of structured estates over his very illustrious 40-year plus career.
Right.
So now he can go back to his tax clients where he knows where all the high net worth money's at, and offshore insurance trusts and all that cool stuff. And be able to say, hey, we got this little fund. If you're interested in playing along, here's our current ROI. And then everybody's eyes boggle and they're like, ooh.
Okay.
Yeah.
So there's your target market right there. That's awesome. And so you had that in mind before you got into the, how is this actually going to happen? Now, so this guy's a tax attorney. Did I hear that right? Okay. And that's important because this is one of the things that I and a former business partner found out about once we started making a little bit of money is like, okay, we don't want to get hit with massive capital gains here and watch all of our hard-earned revenue disappear into the tax hole, right? And so we found out right away the bookkeeper wasn't the right person to help us. The accountant was not the right person to help us. We had to go make several calls to go up the chain and find a tax strategist attorney to give us the plan to avoid blowing money basically and having it disappear, right? So and what we found out there was the person who should be giving you the strategy is not the person who should be carrying out the strategy. That was interesting. Those are two different levels.
Yeah, that's a fair statement.
And I have seen that have you consulted a tax strategist attorney question be a great qualifier. Right. So if you're in a situation where you have figured that out, that like, oh, I have to do this, that means you've probably got the right mindset, and I want to work with you. that's a big.
Yeah, it's just a necessary evil. I mean, when you're talking about, especially the kinds of returns that are possible, and then the short-term, long-term impact of gains. And, I'll just disclaim it right now. I am not a tax professional. Anything that I say on this show should not be construed as tax advice, accounting advice. Please consult, or legal advice. Please consult your tax advisor, CPA, accountant, or attorney for related business matters appropriate to your situation.
We are not giving professional advice here. That's right.
We're just chatting. Yeah, I mean, and it's that's the thing that drove us into the opportunity zone side, because what we saw, we're unlike the traditional venture capital fund where you put your money in, you buy a unit, and you're locked in for 10 years, for the life of the fund. And most VC funds are, family offices, high net worth individuals, whatever. The fund principals will go around and pass the hat. Hey, we're raising a fund, $10 million. Here's our hypothesis. These are the kinds of investments we're going to make, blah, 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 blah. And hopefully we'll do a good job of it. And at the end of 10 years, we're going to liquidate everything, and then you'll get your share back with the gains or losses, whatever that is, right? Well, with crypto, it's different because, when you're talking about digital assets, the liquidity is already there for Bitcoin, for, Litecoin, for, all these other assets. So we offer our investors, our limited partners in the fund, a much shorter redemption window. So they can be liquid very quick. Well, and so what we started to realize, if we're knocking down 80, 100, 150% gains over the next couple of years, the likelihood that some guys are going to take some cash off the table and, play with house money maybe, but, take the scrape while the getting's good. We need to have another strategy to be able to move that capital into as a separate product to help them leverage their tax liability, for example. And that's where the opportunity zone side came in, where an opportunity zone fund, as a qualified fund, allows you to offset already existing tax gain liability. So if you sold a couple of businesses in 2018 and you're sitting there with the clock ticking on coming up with your offset strategy, or stroke a check to the IRS, well, you can make an investment directly in a qualified opportunity zone fund, and then they have a year to deploy the capital after that fact into the other businesses. But you may now axe away a percentage of your existing gain liability, as well as increasing the amount of time that you have to pay it from 1 year to 7 years. Crazy. And then what the fund invests in grows completely capital gains tax free for 10 years. There's a 10-year tax. It's a long strategy, right? But if you think about it, it's like, all right, well, I took a big ass hit, we'll take a scrape on, some crazy investment that makes 80% gains, or I sell a company, whatever, right? And I turn around and I, spread out my liability on that for what I do have by rolling it in. Think of the capital that's coming into private enterprise, and particularly these opportunity zones. They're not the nicest neighborhoods in cities in particular. And then, of course, if you go out rural, I've seen opportunity zone parcels that don't even have a street address, right? It's like woods.
Rural Route 4, yeah.
Right. I mean, it's like there's not even an address there. So, but it's in the opportunity zone. And so that's where you're seeing the first push, which is moving the cash into real estate-based deals in these opportunity zones. So, slummy tenement type buildings that no one's been able to do anything with for a very long time, all of a sudden are now finding a new life. And what's interesting is the existing landlords have to transact and sell the building. So they can't keep it and just put the money in and get the gains. So now there's investors that are coming into these shitty neighborhoods and buying up buildings, but now the landlords are catching on to it. Like, oh, well, this is an opportunity zone. My property, I couldn't get 10 grand for it yesterday, but today it's worth, 1.1 million. So there's a bubble coming in opportunities in real estate, but then we're focusing on the next wave after that, which is traditional venture capital investing in businesses that work out of opportunity zones.
Okay.
So if you're a tech company and you're willing to go work out of a co-work space and spend half of your payroll dollars in a opportunity zone, which is a big qualification for that as a business, consult your opportunity zone attorney. So that allows us to then create a VC fund that carries all this awesome tax benefit, this tax strategy, and hopefully make investments in innovation and companies that are working out of these disadvantaged economically, excluded areas. So,
which, however, 10 years from now could be in quite a different situation.
True.
Because those buildings may be knocked down, and replaced, and
that's it. Gentrification is the thing, it pisses off everybody in the neighborhood now, but I kind of look at it as, well, you've had decades to fix your neighborhood, and you've not been able to attract money and businesses. So sort of the way the cyclical markets work in these things, I guess. I don't know.
No, it's a very interesting strategy. Now, I have seen over the last couple of years you meeting with members of Congress and folks at universities, and most recently that Strategy Institute in University of Florida.
Oh, UCF, yeah.
Good guys. Tell us a little bit about, like, from the outside looking in, from my perspective, these things added so much credibility to what you were doing. I'm like, wow, you're going to get real feedback from these people, and you're going to have the chance to educate them about it and get their point of view on it, and most importantly, get them on board the idea.
Sure.
Something that they may not have even been thinking about beforehand. How did that come about? How do you make the decisions of who to go see? And was there an intentional process here, or was it just, oh, well, I'm going to go and I guess we should meet with some of these people?
Yeah, it was categorical, and it's a twofold strategy, I guess. I have such a huge network personally, which is very helpful. But, categorically, it's sort of like, well, who's my customer? And that's not apparent early on in early stage tech. It's like we've got this innovation, and now, okay, well, we take the lean customer approach, which gives us, call it shorter business windows, the lean startup or the customer discovery model you go out and you poll and you ask your audience, hey, what are you willing to pay for this kind of a solution, right? And when you're dealing with much bigger leaps in technology, the average customer's vocabulary does not yet exist to be able to go to them and ask them, hey, can you conceive of a solution to this particular problem or whatever? And then you got all these barriers, right? And it's like, think about the first company to adopt email. And quite frankly, I should know who that is, but I had no idea. But what a risk, right? Like, well, who are we going to be emailing back and forth with?
Right.
Well, just internal people in the company. We'll save lots of time and,
paper.
Well, we already have these vacuum tubes that we put messages in and they, go to the third floor and they get routed through the mailroom. Like, why do we need email? So, yeah, whatever. So it's hard. The point is it's really tough to keep the baby alive. And that's my number one mission is for any early stage technology, beg, borrow, steal, do whatever you got to do. Now, that being said, if your idea is big enough, that's where the big players, they're going to look at what you're doing and find it interesting. And you just have to think big, and go after people who think big. I would say in my entire career, and I experienced it recently, there might be 50 people in the world that I would consider experts in the combination of structured capital, business models, and software and data. And I most recently had an opportunity to be in a conference room with a conversation where vocabulary and words were not barriers.
Yeah, I'm imagining what that would be like.
It was pretty fucking cool, quite frankly. Just be able to set everything aside. We're all coming from the same taxonomy, and we're able to stream and think and apply the thought processes to what we know about each other's organizations. And that is, when you have the ability to interact with people who look at the world that strategically, that's when I'm in awe. It's like, oh, sensei. Like, oh. So, but as far as like keeping the baby alive, sometimes you got to do the soft shoe hustle. It's just the way it is. You got to go sell consulting services while you're building and selling the product, for example.
Right. So for our listeners who are considering, gee, I've got this cool idea, I want to bring it to market, but I don't know who will buy it yet. There's a two-prong approach here that I'm seeing them. One is you're going to have a barrier to entry, and that comes with no user adoption. Nobody even knows what you're talking about. And then the second side of it is, well, maybe I can go find a few experts. Right. And I think if you find one every 3 to 6 months, you're probably doing a great job.
Yeah, it's really tough because, when you talk to the VC community, they obviously want to compress their risk of failure. And it's very difficult. And you look at the history of venture capital. I'm trying to remember the name of the documentary on Netflix. It's about the original Silicon Valley VC emergence. And, and then we evolved all the way through to, the lean startup, right? And, now I'm a VC, I'm only going to put money into where I have, these attributes or whatever. And sadly, it's hurt a lot of innovation because bigger picture companies can't get funding for the baseline of their of the vision, right, of the tech team. And because the VCs are jaded. They've lost so much money on the whole, well, if you build it, they'll come.
And these folks,
that's not true.
They don't fit in a classification that's qualified yet.
Right. It's absolutely true. You're taking a major risk on a, if you build it, they will come approach to developing and investing in a business. And, unless you yourself are also a subject matter expert in that particular space or whatever, you're probably not going to be able to connect the dots. And therefore, gets kicked out in due diligence. Like, nah, we don't have this. So, but those are also the companies that change the world, right? The technology. I look at like LinkedIn, for example. They went into their B round, their Series B, which was their third or fourth stage of investment at that point, asking for tens of millions of dollars at that point, with zero sales. And but the focus and the approach were correct, right? The approach was, let's build the network. We're building a marketplace. Most modern technology platforms in some way, shape, or form are a network. Software allows me to interact with information that is also interacting with other people, and other people are interacting with that same information, whether that's a point of sale system, e-commerce system, a CRM, it's just like you have these software platforms that are really insided marketplaces. And so LinkedIn had it correct. It's like, if we build our network, then at some point we know that we will be able to turn on a sales model. And then LinkedIn sold to Microsoft, years later for $27 billion cash. So not a bad run for those guys.
Right.
So it's really tied to, can you produce viable evidence that your economic network model is actually going to be adopted and scale, essentially. When you turn on revenue is sort of superfluous. In fact, you might accidentally crush the company by turning revenue on too soon, because now I have to support paying customers with all this operational process of support and customer service and blah, blah, blah. And then that becomes a capital drain on my limited dollars that I need to continue to still build out the platform and my marketplace and blah, 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 blah. So, it's like, well, and the hobbyist amateur VCs hate my guts.
Because well, you just got me thinking differently with that comment of, should I turn revenue on? And before it would have been, of course you should, but.
Well, I mean, obviously a company has to ultimately be profitable to be self-sustainable. We start businesses to, enrich and provide benefit to the shareholders. That's the only reason we have business. Otherwise, we could just be a nonprofit or a government program or something. If I'm a for-profit business, I don't get, this is the other thing people throw darts at me, is I'm kind of critical of social impact investing. It's cool. It's, it's great if you can pull it off. I don't decry the social aspect of it, but trying to combine that with a capitalism model is very difficult, because the nature of capitalism is capital efficiency. And if I'm having to say, well, my charter, my mission, I'm going to do much better in the marketplace and gain 4 additional percent of market share because I'm green and customers will gravitate towards that. I get it, but in the end, the most efficient capital model is going to be the one that survives. That's more profitable to be able to go out and acquire more market share and pay more money.
Yeah, being green does not mean you can lower your cost of customer acquisition.
No, and you're probably raising your fixed overhead of cost of value prop delivery of whatever you're selling. So
there's your challenge. All right.
Tell us a little bit about. It's like nerdy, man. I'm sorry. I'm taking you guys.
That's good. I like it.
The Hobbit journey here.
Right. Tell us a little bit about a couple of these visits then, of who you met and how those conversations went. I guess let's see if you can pick one where you came in and they were in a relative state of confusion about the whole concept and you helped them along, and then maybe somebody who you talked to, like maybe the sensei figure who just got it.
Well, I mean, solving problems is what we do every day, all day long. So hopefully every interaction I have with someone else means I've solved a problem for them at some level. I don't always get the value coming back the other way for that I should, but that's all right. I guess I'm kind of on the other side. When you say big conversations, I mean, definitely I have some pretty significant advisory capacities that is Capitol Hill, Congress, United States Chamber of Commerce. I've done some advisory with their Emerging Technologies Committee in the past. Yeah, I mean, I think for people who are trying to figure out how to make impacts and get things done, it's pretty easy to get into big rooms, especially in government.
Okay.
You can climb into big rooms relatively easy with the right story, and obviously you can't be a dipshit, and you have to have all the boxes, the prerequisite boxes checked.
Right.
But let's assuming you're a reasonable human being and you've got a really pretty good idea, and you're very clear on the value proposition and the wins, where those are at. You can definitely get into big rooms fairly quickly. What you can't necessarily do is go in with a hard ask very quickly. And I think the timing wise is really a big mystery for a lot of business development salespeople trying to go out and knock down big doors. In fact, it works heavily against you. It's like everybody sort of has this social credit. And if you're helpful and you're helpful and you're helpful and you're helpful and you're helpful, your bucket's full of awesome, like, hey, this guy's here to like really help us clear the mud out of the water. And then, but then you have an ask, right? It's like, ooh. And everybody, unfortunately, is like, they're always thinking, when's the ask coming? When's the ask coming? When's the ask coming? Right? When you interact with them on the front end. And, but, I guess it also comes from the fact that I've also paid it forward so much with a lot of people that if I need social credit, I can get vouched for depending on where I'm going. It's always better to have people saying awesome stuff about you than you saying about yourself.
Right.
Kind of, it's just the way it rolls. I don't know. That was kind of philosophical there.
That's cool. And I think there have been a couple of answers that you provided that were different than where I thought you would go, and that's valuable to me. Hopefully it's valuable to the listener.
Sure.
Has there been anybody who you've encountered where you're like, wow, that turned out great? Like, maybe a little even better than we expected, or?
I mean, like specific deal, or just
well, not even a deal. I mean, I'm not trying to
conversation?
dig for factoids here or something like that.
Right.
I'm looking for the general, like, how does this work kind of thing for somebody who's listening, goes, okay, well, it's all great for Michael with his Capitol Hill experience and contacts to go out there and then go and meet with, some of these larger organizations, or I'm just waiting for their page to open up here. Central Florida University's thing here. I've got white papers open.
Well, we went to UCF.
Simulation and Training Institute.
Well, so you got to remember that all organizations, everybody in substantial leadership positions, are involved at some level programmatically with other organizations, other customer bases, other partners, constituents, besides just their own organization. And so, when you sit down and you talk to a university, for example, you're talking to them not only in context of, what ultimately you can get from the university, which is obviously PhDs, academia, research, whatever. But then you're also injecting into sort of the substream of who are they partnered with? What's the agenda of their partners? So a lot of universities are involved in, government research, for example. So knowing what somebody is trying to achieve in a particular research project, for example, may connect you not only to a university, but to government agencies, private capital. There could be one or more early stage businesses springing up around a particular research project. So just understanding how to identify and read a business constellation is what I call it.
Okay.
Most businesses have a val prop of some sort, value proposition. And when you step back and you look at a business as a link in a much bigger network or a bigger networked ecosystem, then you recognize how individual businesses' value propositions are affected by and affect other value propositions, whether it's supply chain or banking systems or any of the major systems of not only a single business but an entire marketplace, right? And that's also incidentally one of the things that we try to develop blockchain around, because we recognize blockchain's inherent ability to power economies. It's not powering a value proposition. There's no such thing as a one-to-one value proposition with a blockchain. In fact, if you're trying to use blockchain to solve a one-to-one business value proposition problem, it's too expensive. You're wasting your time. You don't need a blockchain. You can use MongoDB, right? If you're trying to do things to enhance a business ecosystem, where you are literally creating and facilitating a transactional economy, that's where blockchain shines. So, it's why it's a natural when you look at capital, business processes, market ecosystems, and then, how do you bring in an information platform like a blockchain to power and support all that? That's kind of the basis of our academic focus. So as we overlay economics with information systems and capital, all these things, that's really the kind of stuff we specialize in. Whoop, 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 whoop.
B310 XTS t-shirt is featuring again for those who are listening. So,
right.
All right.
It's
so
really nerdy though. So I mean,
well, no, I have gotten a couple different ways of looking at things from listening to you today, Michael. It's been super valuable. In general, how hard was it to get your fund certified and be compliant in that? Was it,
you're talking the which fund, the Opportunity Zone fund?
Right.
There's a process with the IRS.
Yes.
It's a Treasury Department form filings, and you got to stand up the legal structure of a fund, which is typically, we're a traditional GPLP structure, so we're general partnership, limited partnership structure.
Okay, so not rocket science, surprisingly.
No,
I had thought because this is blockchain and it's new, maybe people hadn't figured it out yet so much.
Well, this is really apples and oranges. So when you have the blockchain side, that's just a traditional fund. We're a 2 and 20 traditional. 2 and 20 means we take 2% management fee annually and then a 20% success fee annually on the gain.
Okay.
So if you put $1 million, say we raise $1 million and we double it, right? Well, we're going to take 2% of that as a management fee, and then we'll take $200,000 of the gain, 20% of the upside as a fee, leaving 80% of the remaining return to the investors.
Okay, makes sense. All right, so there you just need the accounting skills and the lawyer skills, and
well, God forbid anybody hires me to do accounting, because that's not
right.
So we have an auditor. We have a couple of things. We have a fund administrator. We got an auditor. Accounting firm. Got great law firms, securities attorneys. In addition to my partner, who's an attorney himself. So.
Okay, just trying to give people a mental picture of what it takes to do that.
It ain't easy.
Yeah, who should attempt to do what you've done, to follow in your footsteps with something a little different? Or is this just a look, kids, stay outside?
No, I always encourage growth and trying things and stubbing your toe. Unfortunately, when you get into regulatory stuff, you stub your toe, you go to jail. So,
and you can't do it again, probably.
That's right. Always have a great attorney on speed dial. It's like our number one, our partners. We all laugh and say our number one rule is don't go to prison.
Right.
So,
right. Don't die. Don't die is my number one rule.
Yeah, well,
they're quite similar.
Yes.
You don't get another chance if you do that.
As far as like, if you haven't been involved in a business at a strategic level where you understand these concepts
Mm-hmm.
and have at least been exposed to them in some level, this is not the kind of thing that the average um, mid-level HR manager, cubicle
Mm-hmm.
dweller is going to leave their job and go start a VC fund, or leave their job and you know uh, I'm the culmination of ultimately on the tech side 40 years worth of
Mm-hmm.
tech. I was a little kid, and then on the professional side, I got lucky, and because I had the tech, right, and because I was exposed to the vocabulary and I had assimilated the knowledge, that allowed me to very early in my actual business career um, engage in the right conversations with the right kinds of people.
Mm-hmm.
And I'm like, oh, well, you're useful. Now I didn't figure out how to leverage that until maybe halfway, 2/3 of the way into my professional career to where I'm at now. In fact, one of the things I had to really get past is my attitude towards capital and money. Um, if you can solve problems for people and you can create efficiencies, you are unique.
Hmm.
You are more valuable than the capital. Capital is a commodity, right?
Right.
But if you possess the ability to put the processes and the teams and the frameworks and those kinds of things in place,
Hmm.
Properly positioning your self-view of your self-worth
Mm-hmm.
in context of capital and people with money helps to, number one, exhibit a level of confidence that's recognizable by high net worth and very senior decision makers. But then it helps you navigate through difficult discussions, for example, right? I don't have to discount myself because there's
Right.
10 other people over here that I'm waiting to go talk to. I'm doing you the courtesy. Would you like to know more? Would you like to hear more? Kind of a thing. But I'm not going to spin my wheels. Why should I do this deal with you?
Hmm.
Right. And it's not an arrogance thing, because people that really know me know that I'm probably one of the most self-deprecating. It's like I'm just me, it took me a long time to even take a compliment well.
Hmm.
It's just childhood trauma and emotional bullshit. We all,
Mm-hmm.
sorry, vulnerability moment there.
I've
But
been there.
we all have,
My
man.
parents would tell you the same thing.
We all have. Every human being, there's no secret. Every human being walking on this planet is scarred by their trauma in such a way that is compromising their ability to achieve what they're capable and probably destined to achieve in their lifetime. And that's just, you just don't see it. You're blind to these things. And sadly, most people live their whole lives and go into the, hereafter with, just this sort of, chocolate pudding covering, like, well, woulda, coulda, shoulda been great. Death of a salesman, right? Willie Loman.
Yeah. Sad but true.
It is, it's like, anyway.
So okay. So the change in view about capital and money and reorienting yourself, and once again, I'm hearing another thing from you that I need to go and take away and work on with myself. Very interesting.
Yeah, I mean, if you value what you do,
Mm-hmm.
number one, your time,
right,
is your most valuable commodity.
Right. Yep, it's lettuce. It spoils, and you can't get it back.
That's it. And we always assume we have more than we really do. But and then that unique value that you can bring is worth more than the money.
Mm-hmm.
Right.
Interesting to think about here.
Well, think about it like this, Jason. Like, as an employer, I want to pay you $100,000 a year. What do I expect?
Probably more than half a million a year or more.
More than $100,000 a year worth of that. Right.
Right. That's a great place to start. Okay. Well, Michael, who should be talking to you? Who would you like talking to you? If they listen to this, how can they know that, hey, I'm in a position where Michael can help me and I should maybe go seek him out?
Well, you can always follow me on social.
Mm-hmm.
My social channels are different for different social channels because I have different connections and friends and audiences. So,
Right.
you know,
Yeah, my LinkedIn is different from my Facebook,
yeah,
definitely.
of course.
Yeah.
So I don't have a lot of time to, listen to long-winded pitches. Um, Fortunately, I've been able to build channels for myself. So somebody says, "Hey, I want to be part of, your mentorship for my startup." Well, unless you're in southwestern Ohio, or in my region, Cincinnati region, plus 50 miles or whatever, you probably won't get the opportunity to work with me directly because I have a channel called Cincinnati Founder Institute, and I can put you into that channel and that lane, and then effectively maximize my time and my efforts with my team. We've got an awesome Founder Institute team here locally. My co-director that I brought in, I just reorganized the chapter and just brought in Adam Kaler this year.
Mm-hmm.
Adam was the co-founder of Loop, which sold to Zillow for $100 million cash. So, and he's a good old boy, grew up in the West Side ghetto and made good, and just the most down-to-earth person you'd ever imagine. And he's just in the right place at the right time, got a 9-figure exit out of it. And, that's the level of talent we try to bring in as mentors, directors for our local program. I highly encourage, if you're not in my area, to explore Founder Institute as an accelerator opportunity if there's one in a city near you. They operate globally, 180, 200 cities globally. Then in terms of if you are looking to raise money or those kinds of things, if you're a startup, that's one thing. If you're a fund or whatever, that's another. Family offices can contact me directly because I have plenty of avenues for your capital. So, and that's a whole separate story by itself as well. But it just kind of depends on how you want to engage and take a look at it. If I don't get back to you right away, I just know that I do see everything, and it just takes me time.
Right.
So.
Awesome.
What else, man? What else? What else?
Any specific? Well, we've been talking for almost an hour, so I want to wrap up, but we could definitely have you on again and focus on a different topic than the blockchain that we focused on today and fun.
I don't feel it. Did we focus on blockchain?
A little. I mean, this was interesting because it didn't go where I had planned it to. Half the questions that I wrote down to ask, I didn't bother asking because they kind of evaporated. Like you partially answered them on the way, and also some of them became far less relevant than I thought they were. Sure. At the time that I wrote
I'm happy to take whatever dive that you'd like to in whatever topical direction, with enough advance notice. But in terms of, what did we miss today? It's your show, Jason.
Yeah,
so.
No, I'm delighted with what we've covered today, and I'm looking forward to the reaction the audience has. And
Hiles is talking on microphone again.
They could tell me what we missed or what we could dig into more. But you've given me at least three ideas that are floating around here right now. I don't know if you can see them, but that are making me think and have to review some things. So after we're done, I'm going to be back on my little notepad here that I was working on today with. I did a little force field analysis of my own business and how I'm feeling about it. Stuff that, advancing me and stuff that's blocking me, and I got to figure some stuff out there. So it has been great to have you on. Is there a place people should go, a website or a specific place, social to follow you?
You can follow me. I'm Hiles Files on Twitter, at Michael Hiles. That's probably, if you're interested in the blockchain and the business, that's the most accessible, and you don't have to necessarily friend me up per se. You can just track with them.
Awesome.
Track the people I'm tracking. There's the normal social channels. I'm pretty easy to find. Yeah.
Awesome. Okay, well, thanks a lot for being my guest today. This has been Michael Hiles, and we have talked about a whole bunch of what I think most people would think of as pretty high-level money management, wealth creation topics. Thanks for being here.
Cool. Thanks, man.